Okay, FIMM integration, some main points. For example, we have a scenario over here. Purchase order is created on 1st January for 50 quantity at 100 rupees each, which is 5,000. On 10th January, goods are received for 50 at 100 rupees. So both these things are matching, but this is not a financial impact thing. Financial impact happens at this point when goods are received. So 5,000 stock debit and GRIR account credit, because we didn't receive the invoice on 10th. We received the invoice on 18th, which is a week later at 110. And the stock is not issued for sale or production. So our inventory account on the day of receiving goods, 5,000 is done a debit to inventory account. This is the transaction code. Stock is not issued. Invoice that is received, okay, it is something like this, that the GRIR account, which is uh, which was already credited, it will now be debited because we have received the invoice. It will take place and replace the GRIR account. So this is knocked out. So for knocking out, it will be open item. Rest, the invoice will be again absorbed in inventory account by 500. The vendor will have a credit of 5,500. Scenario 2, purchase order is created on 1st January for 50 quantity at 100 each. On 10th, we receive the goods for 50 quantity at 100 each. On 18th, we receive the invoice and stock is issued for sales. The invoice is received on 18th for 110. So inventory debit, GRIR account credit. Stock issue, cost of goods sold because we are issuing it to sales. For 25 quantity, 25 at 100 will be 2,500 and the inventory account will be credited because you have the inventory account as debit. From that, you will credit it. Upon the invoice receiving 5,000 of GRIR account is knocked out. Inventory account is debited with 250 and purchase price variance of 250 is also given. And vendor is credited with 5,500. So debit of inventory and debit of purchase price variance. Okay, this is done at this level. Okay. Scenario number 3. 1st Jan, 50 quantity, PO raised, 100 each. On 10th, goods are received at 100, that is 5,000. Invoice is received for 110, which is 5,500. Stock issued for sales, 50 quantity. Okay, so entire stock is sent to sales. So inventory, debit, GRIR account credit. Cost of goods sold, debit, credit, inventory, 5,000. So it is all knocked out. GRIR account is knocked out. Inventory account is already 0. Okay. Purchase price variance account is debited with 500 because of this 10 per piece difference and the vendor is credited. So we have vendor credit, but inventory is already 0. So in SAP, the integration between FI and MM is crucial for ensuring accurate and seamless process. The integration between FI and MM involves flow of information for procurement, inventory management, and finance. So being an FI consultant, our role is to provide correct GL account consult for inventory, GRIF, and vendor account, and price difference as well, price variance. So transaction code is OB by C, GL account is mapped to valuation class, maintain material master by MM, consultant, and transaction keys. Transaction keys are this. We'll see this when we go into the configuration of this. Okay. Now this is the procure to pay process, purchase requisition, purchase order, good receipt, invoice receipt, vendor payments. That's it. 5 parts. And these are transaction codes: ME51, 51N, 21N, MIGO, MIRO, and we have vendor clearing with F10, F1110 and F-53. Okay, that's it. We'll do the configurations in the next lecture.